and thank you for joining us for our latest Kanawha video. Last week, something eventful happened. The S&P 500 made a new all-time high, and we thought that presented a good occasion to reach out to you to provide some historical context for what that means for the markets and for investors. A common question that we get whenever a market index makes a new all-time high, in particular after a prolonged bear market like we had seen over the past 2 years, a natural question is, did I miss it? Should I sell my stocks? Or if I'm sitting on cash and delaying an investment, should I wait until there's a pullback? We think that you'll be surprised at what the historical tendencies show us. It tends to happen after the market, like the S&P 500, makes a new all-time high. So let's jump into the numbers. Just a quick recap here. Before January 19th of this year, the last time the S&P 500 had made an all-time high was back on January 3rd, 2022. There were 746 days between that all-time high and the new one made earlier this month. And that's over 2 years. That feels like a long time. As we'll see in a moment, as far as bear markets go, it was by no means the longest. But one thing that I think made this bear market more difficult to live through in particular is that bonds were also suffering significantly during that stretch due to the significant rise in interest rates that we saw. How does it stack up against historical bear markets? Well, I have this table here that shows bear markets in the S&P 500 going back to the late 1950s. You can see in that second line from the bottom that I crossed out the bear market associated with COVID. And that's not to suggest that wasn't a real bear market. Obviously it was. But I think that because of the uniqueness of that situation, how quickly it came on and how quickly the Fed and other central banks around the world stepped in with monetary stimulus, plenty of governments implemented fiscal stimulus, it really just flooded the market with liquidity and a lot of support. And that's why we saw that V-shaped snapback recovery. So for the purpose of historical comparison, I felt it was appropriate to exclude that. And when we do that, we need to go back to the late 80s. If you see that bear market about middle of the way down the table that ended in 1987, you can see that that's the last time that we've had a bear market shorter than what we just experienced. That one lasted 701 days. And the other bear market in the 80s lasted around that same time period. If we're discussing the degree of the bear market, you would actually have to go back to the mid to late 60s, that bear market that took place in 1966, to see a market decline from peak to trough that was less than what we just experienced. In 1966, the S&P 500 fell 22.2%, compared with the peak to trough decline that we saw in this most recent bear market, with that trough being in October of 2022, where the S&P 500 lost 25.4%. Again, not to dismiss or minimize the bear market that we just went through. It was certainly a difficult period for investors to experience, but on the other hand, by no means drastic when compared historically. So again, as I said at the top, the natural question is this the time to sell, or should I delay my investment? And what I'm showing you here is a classic behavioral finance chart, the cycle of investor emotions through market cycles. And this is a chart that you've probably seen before, and I love it because I think it really expresses 99+% of human behavior when it comes to the stock market. And I think a lot of people may be wondering right now, where are we on this upward slope of the curve? Are we closer to somewhere between reluctance and optimism there on the far left? Or are we closer to the excitement, exuberance range? I think it would be understandable for you to see a headline in the news about a new all-time high in the S&P 500 and just naturally, automatically think, okay, well, we must be close to that exuberance. Because we've experienced such a strong rally over the past several months to get to this point. But what I'll show you in a moment is that, if anything, reaching a new all-time high after a prolonged bear market can be a signal of strength. Before I move on from this slide, I think that it's important to emphasize that no investor can really reliably time the market. No one knows in advance where the peaks and troughs of this curve will exist. And that's why we like to say it's more about time in the market than timing the market, and just investing in a way that's appropriate for your goals. Here I'm showing you a table of what the forward-looking return looks like for the S&P 500 over 1, 3, 6, and 12 months after a new all-time high is achieved after a prolonged bear market. You see a lot of green on this table, and that's because, maybe counterintuitively, we see that once that new all-time high is achieved, markets continue to do well in the year that follows it. And in fact, if we look at the far right column here, we can see that going back to the late 1950s, there was only one 12-month period following that initial all-time high that resulted in a lower return, a negative return for the S&P 500. And that, of course, was in May of 2007 when the index lost 8.6% over the next 12 months. If we aggregate all this data, we can see that down there close to the bottom right of the screen, the average or the probability that the market will finish the next 12 months higher after a new all-time high is reached is over 92%. And that's actually interesting because in any given year, if you look at the number at the very far bottom right there, in any given year, the likelihood of the market finishing higher than where it started is only 73.5%. This is counterintuitive. A lot of folks right now may think, well, the market just made a new all-time high. I don't want to buy in at the top, so I'm going to wait. But if anything, history is showing us through this table, again, next year could look completely different, but historically speaking, you have a higher probability of the market being higher after this new all-time high is made, not a lower one. It's important to keep all this in the context of the current risks that are presented in front of us, and just to name a few of them, what we're seeing in the narrative and the consensus right now. First and foremost, the market expectation for rate cuts is ahead of the Federal Reserve's projections. When I say the market expectation, I mean that both stocks and bonds seem to be pricing in a greater number of rate cuts in 2024 than what the Fed is telling us they plan on doing. Another thing is that the incremental decline of CPI, PCE, other measures of inflation is likely to become more stubborn, more gradual as we approach that 2% target of the Fed. It was much easier back in 2022 and 2023 to get from 7 or 8% CPI down to 3.5 or 4% than it will be to get from that level down to the Fed's 2% target. So to the extent that CPI and other measures of inflation remain stubborn, it may create more volatility for the markets. The third point is that, listen, the labor market as it stands today is still very strong. We are still enjoying record low unemployment. But what we have seen over the past several months is that the monthly addition of jobs has begun to decrease a little bit from the really hot numbers that we saw at the beginning of 2023 and the end of 2022. To the extent that trend continues, then it could create more fears about recession and an economic slowdown. Another point is that consumer finances are increasingly stressed. The last remnants of that stimulus money from the COVID era is all but gone. Consumer credit consumption has increased. People are putting more on their credit cards and other debt mechanisms. And so it's reasonable to think that consumer spending may slow down. And then lastly, of course, the unknown unknowns. We don't know what else could potentially upset the apple cart in this market. And it's typically those crises that we do not see coming that by definition provide the most volatility and most downward pressure on the market. So what are the takeaways, just in summary? A new all-time high is not only not a reason in and of itself to sell or delay an investment, but it can be a really good signal of strength, at least for the next several months in the market. Keep in mind that every market cycle is different. You should invest according to your own risk tolerance and objectives. And last but not least, regardless of where you think we might be in the current market cycle, focus on investing in high quality stocks, investment grade bonds that are trading at justifiable valuations. If you stick to that game plan and you allocate your portfolio in a way that's in accordance with what your risk tolerance and your goals and your liquidity needs are, then in the long run, you're going to be just fine. I hope that this has been a useful video for you. Please feel free to reach out to us if you have any questions or concerns. And otherwise, I look forward to catching up with you next time we do a video.